This chapter is all about structures, which is an extremely important topic that can bring you a lot in trading. And it above all gives you the opportunity to find your way around the chart at any time. Thanks to structures, you are able to better classify where we are in the market and which zones you should better not trade and which direction you should trade. And when asked what structures actually are, I answer that they are the result of liquidity. They show what the major market participants have actually done on the market and what liquidity has led to what movement. If we put all this into context, then we are better able to draw an overall picture and we can replicate the course of the big money through the market. And through this replication, we are better able to apply the whole thing systematically over and over again. Because if we have no criteria by which we can determine the direction in which the big money is heading, then our results are more of a coincidence, and that is precisely why we use and need structures. Structures are a powerful concept that we break down into all time frames. But there's one thing we need to look at, and it is the fractal nature of the market. This actually just means that everything repeats itself over and over again on all time frames. This means that what happens on the 1 minute chart also happens on the hourly chart. Fractals, like in mathematics, are simple patterns that occur again and again. This means that a single part of an object is similar to the whole thing. In our example, this means that a downward trend starts in the minute chart and then can be seen in the next larger chart and continues until the highest time frame. In other words, we see a downward trend on the minute chart, and this downtrend is repeated again and again on the minute chart, until at some point a downward trend can also be seen on the hourly chart. In this way, you can imagine different dimensions of structures and thus better recognize where you are at which time in the market. These fractals can be used to determine, for example, that the daily chart is bullish but the hourly chart is bearish. This shows a difference in the market structures. This means that in this example, you could look for a long trade in the market as the higher time frame is long and the lower time frame is short. The higher time frame is always more relevant than the lower one, but in certain market phases, the lower time frame may be more relevant for us, for example in a distribution. But we will go into this in more detail when I present you the system later on.